I'm not giving up on the Santa Claus rally just yet, even after last Friday's nasty move to the downside. If we do get a positive Santa Claus rally close, it sets up the first component of the January trifecta, which historically has led to a more than 90% probability that the upcoming year closes green. But if this week we break a key level in the S&P 500, it's game over and it's nothing more than a bull trap to kick off the new year. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan specifically around that key level I just mentioned. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we typically do, what do we see in terms of candle structure? We've got ourselves a green-bodied inverted hammer. So what makes the body of this bar green? Of course, it's that the close is over the opening print. So if we're thinking about whether or not we have stronger sellers participating in this market, I would say that we don't really have stronger sellers. Stronger sellers would have moved underneath the opening print and would have caused a red-bodied close towards either the lower third of the range here, or they would have just expanded range further in the downward direction. Neither of those things happened. So it's not really that bearish, but is it really that bullish? Of course not. A defining characteristic of the inverted hammer is the large upper wick, where we know that sellers stepped up towards the highs of the weekly range, and if we had stronger buyers, they should have achieved a close up here in the upper third of the weekly range. So it's really a neutral bar here on the weekly chart. If we're thinking about location on the bar-to-bar count, you can see that we have a lower high as well as a higher low. It's a very classic inside bar. Another neutral indication here on the bar-to-bar count. So all we're really left to do is just continue to lean into the fact that we have lows, higher lows. These were soft higher lows. These were firm higher lows. These were soft higher lows. We're trying to build out firm higher lows on the weekly time frame chart. Notice that we've closed the weekly bar once again well above 585, which is our key level. We've been talking about this for the span of like a week and a half now, right? As long as we're over previous resistance, which acted as support and is continuing to act as support, I would maintain the stance that the weekly trend is up, and we've pulled back from the highest high in the trend count. And all of this is taking place, as we all know, over the Fibonacci 38.2 from here to here. That's bullish. And if we come in from the last major high or low up to the most recent all-time high, this is taking place over the 61.8. We talked about this confluence last week. And notice that we've actually closed this week's weekly bar over the Fibonacci 38.2. It's not groundbreaking, and it's not like, oh my goodness, the market needs to go on to produce brand new all-time highs. But it is a small step in the upward direction for the buyers. Once again, I would maintain that bullish stance here on the weekly time frame. Let's come in with the weekly anchored VWAPs. We're right at the top of the anchored VWAP cluster here. Would have been more bullish to close once again in the upper third of the weekly range over that anchored VWAP. That's the election move to the upside. That's the anchor point for that VWAP. Would have been best to be above, but once again, did the sellers really make progress in the downward direction, breaking through other lower anchored VWAPs? The answer is absolutely not. So I wouldn't really be bearish from that perspective. If we clear this up, there's one minor bearish data point that I think is at least worth entertaining here, and it sort of falls into the same category of the soft higher lows, soft higher highs, and soft lower highs are a possibility as well. What do you notice about this high volume node? It's probably confluence with the top end of that red bar back here, but it's also the upper wick of last week's candle. So I wouldn't go out on a limb and say that, oh my goodness, guys, this has to be a lower high in the trend count. You have highs. This is a lower high. Absolutely not. We have not flipped into a daily uptrend yet, which is what's required to solidify a lower high on the weekly time frame chart. If we get into a daily uptrend and we cannot make it up to the all-time high, then we'll have a lower high, but we do not have that as of right now. So the weekly trend maintains its overall bullish nature. It's up, right? We're trying to figure out this weekly higher low thesis here, and so long as price is above 585, there's no concern on the weekly. And heck, let's just play devil's advocate. If we break down under 585, is the weekly trend down? The answer is no. The weekly trend is neutral, coming into the equal low, which is much closer to the 570 mark, as we talked about in last weekend's update from the Saturday video. Let's drop it on down to the daily time frame chart, though, because this should not be much of a shocker based on last week's pathing. First things first, let's evaluate this week's expected move. It's the gray shaded area. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 603.43, implying basically an equal high to last week's high. But most importantly, it keeps us underneath this overhead supply, underneath the bottom of that balance range. And that's really not all that bullish, right? If we're contained by the lower bound, the number is down here at 586.68, which technically implies a higher low from the Friday gap down of 2 weeks ago, but I really would not consider this a bullish spot for the market to go to try to maintain the bullish uptrend that it's trying to build on the daily time frame chart. So let's talk about this in relationship to last Saturday's pathing ideas, right? We had talked about the competition of the time frames, how the weekly time frame chart is really trying to maintain the higher low, the firm higher low at this 585 area. We had talked about relative to the August 5th gap down back over here that you usually don't want to overstay your welcome looking for a big daily downtrend to persist. Recall that we had said it would have been great if the sellers could have kept a lower high underneath the bottom of this balance range here. It didn't happen. Obviously, there was no daily downtrend. It was a V-shaped recovery. Well, if we come back on over to this area here, last Saturday, we had talked about how if this produces a lower high, it's a good first step for the sellers, but I would not flip to being bearish until what? Until this actually turns into the head and shoulders pattern that everybody and their sisters, brothers, mothers, aunts, goldfish can see. If we get a right shoulder and we make it down here to the equal low, I will change my tone and I will be bearish. I will say, yes, there's absolutely a threat of the neckline breakdown to close the remainder of the election gap. That's underneath 583.85. It's really the low of the gap down day over here, which is 580.85. Under that, we can fill the remainder of the gap down to 576.75. But what did we just learn about the August 5th example that we were just looking at off to the left? We don't want to prematurely get involved in daily downtrends. As a matter of fact, I would prefer if we could start to say, okay, we have lows, and this builds out as a daily higher low. This is absolutely the line in the sand here for the daily higher low to form for a number of reasons. First and foremost, just looking left, it's a key technical level. You have the top end of a previous balance back here, but even more importantly than that, you have the Thursday opening print of the follow-up session to the Powell plunge, right? So what does that tell you? Anybody who's aggressively short still from this location down here is not getting paid. Then we can look at the daily 50 SMA. It's right there in blue. As long as we're over that, we're probably feeling a little bit more bullish than we are bearish. What do we have in terms of Friday's structure? I don't know about you, but it's a red-bodied hammer candle where buyers clearly responded at the lows of the daily range and were able to close towards the midpoint, close towards the Friday highs of 2 weeks ago now. So walking forward, I would prefer to see the exact follow-through of the pathing that we outlined last Saturday. We had talked about how, hey, we should probably get a V-shaped recovery to 603. Please reevaluate at 603 because it's the bottom end of the overhead supply. It would make sense that a pullback could unfold there. Great, we've seen the pullback. This hammer candle is suggesting to me that if we can hold this higher low over 590.75, perhaps we look for a long, this would be over Friday's high, to get back to 603, we'll reevaluate the chart there once again, but coming from a low and now subsequent higher low, this would be high, this would be equal high. If we're going to start a new daily uptrend, we should really be looking for higher highs, and where does that bring us? To the all-time high at 609. So the preferred path that I would like to continue trading for here out of the S&P 500 is absolutely a bullish Santa Claus rally close. That's this Friday. As long as we're over Tuesday's open, by the time Friday closes, we have a bullish first component of the January trifecta. The Santa Claus rally has closed green. And then we'll look for the first 5 trading days of the January month, right? So one step at a time. Let's make sure that by Friday, we're over 595.25 basically to set up the first component. And this is still making sense based on the analysis that we just talked about. Now, once again, I'm not going to sit here and I'm not going to be blind to the fact that if the market, moves down here and is consolidating, that's absolutely more neutral. If we're over 590.75, but under 595.25, sure, we're probably a little bit more neutral than anything else. I wouldn't be pounding the table for, oh my goodness, here comes the all-time high. If we slip underneath 590.75, again, I'm not going to be sitting here trying to blindly long this thing if we're setting up the big-time head and shoulders that everybody can see. We will acknowledge the pattern and we'll change our tone when it's appropriate, but it would have to be price acceptance underneath 590.75. So that is the analysis here on the daily time frame chart. It's still bullish until proven otherwise. I do quickly want to come in with the VWAP, sorry, not the VWAP, rather the Fibonacci's from the Powell plunge, and what we'll see here is that the Fibonacci 38.2 still confirms our key higher low line in the sand on the daily time frame chart. Remember that if we can really start closing bars over the 61.8, which would roughly be Friday's high, if we can close bars there, then the 100% retracement becomes more likely. If we get back down underneath the 38.2, then what is it? Technically, it's further bear flag consolidation. And obviously, the head and shoulders pattern is in force on the daily time frame chart. So generally speaking, I like the way that the fibs are confluence with the key levels here on the daily. Let's drop it on down to the hourly time frame chart. Let's get even more granular and talk about what unfolded last week. So the first thing I think we could talk about is the one time framing has stopped. Here's Friday's low. This was Monday's low. Tuesday's low, Thursday's low. Obviously on Friday, we made a lower low on the bar-to-bar count, but it did end up closing as a hammer candle. So generally speaking, I would say that the pathing probably wants to follow a move that looks like this is bullish. You could look for longs here for risk reward back up to 603, or if you'd like a little bit more confidence, you could say, okay, I want to see a move back into the Thursday range over 598, probably sets up risk reward that looks something along these lines. The most bullish outcome, again, if we just extrapolate the path in total, is this mild pullback and then some sort of Brigade bolt back over 603 to get that rotation towards the all-time high. This is like pounding the table, oh my goodness, rainbows and butterflies, bullish outcome here, right? Where things change up a little bit, as we've already mentioned, is that this is neutral consolidation, right? I would not be bearish and I would not throw in the towel if we're over that 590.75, but absolutely if we start to break down underneath this, what did we just draw on the hourly time frame chart? Think about the concept of a Russian nesting doll, right? You have left, you have a head, and now you have a right shoulder. If you're underneath this neckline here, which is the daily line in the sand, what's the likely outcome? Well, these shorts are back to feeling pretty darn good about their positions and will start thinking more so about the election gap closing. One thing we can think about here in terms of psychology is simply that on the Friday open, you opened on a gap down, very, very small and subtle gap down. The gap basically closed, but there was no semblance or fight. There was no attempt from the buyers to try to get price acceptance back inside of the Thursday range. So headed into the upcoming week, I would really have to think that as long as we're underneath 595.25, I would not pound the table aggressively for a long if we're underneath that level. You would have to see some sort of thin structure retracement over that level to start getting on the long side of the market. So the levels, they're very, very clean here. Very, very clean. You can see the way how this has reacted. You can see the way how this has reacted. I really think the focus early on in the week is 595.25, 590.75 for all the reasons that we've just described. And generally speaking, my feeling is that if the daily trend is going to flip to up, we want to participate in these green dots right here. Let me go ahead and grab the green crayon. We want this higher low for a thin structure retracement back up to this high. And we want this higher low over Friday's high of day to put sellers off sides, because think about what this suggests, right? Now all of a sudden, anybody who shorted the big move to the downside, shorts late to the party, they're screwed, right? So not only do we have shorts screwed from back here, but over 595.25, shorts late to the party from Friday, also screwed. So these two green dots would be my preference. I'm willing to be open-minded to sideways consolidation in here, and I will likely have to change my tone on the market if there is some sort of move to set a lower high underneath 590.75, which as of right now, if I had to put probabilities to it, this is the lower probability outcome. This, to me, I would like to see as the higher probability outcome. We've already talked about the Fibonacci's. Let's come in here with the intraday anchored VWAPs, and we'll move this show along. Notice that, we are closing still over the JPOW anchored VWAP, right? That is this one from back over here. If you follow that through, it's right in here or here. It doesn't matter. Even if you come in from the gap down low of Friday, you're over both of those areas. Now, clearly, if the market wants to get into this zone, where do you clear all of them? Over that 598 level, which was one of the green dots that we were just talking about. So all set from that perspective. One thing that we can one thing that we can check in on is just this Fibonacci. It's similar to the Powell plunge Fibonacci, but maybe slightly different. And I think that what this does is maybe it aligns more so with if we could just get over that 595.25, probably looking for 603 once again on the upswing there. Let's check in on the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see over here? Generally speaking, volume flows were not really that aggressive on both the Tuesday rally where the market was just like up, and away, but also on Friday's breakdown. Notice that you did not see a substantial move underneath negative 300 million. Compare that to the big old rally back here from Friday of now 2 weeks ago, and you can clearly see that we still have a stronger inflow of capital and liquidity volume to the market rather than outflow. It doesn't mean that things can't change, but I would not be aggressively bearish based on pure volume flows. If you go ahead and hide this, notice that the outflows were a little bit more substantial here on the Friday session, but sort of fine on Tuesday as well when the market rallied in the first place. So that kind of cancels itself out in my view. And once again, it was didn't seem like big aggressive, oh my goodness, this is strong methodical selling that's going to push the market big time lower on Friday. It was a big emotional push off the open, and that was it. Obviously, we got that longer lower wick where buyers responded off of that key level into the afternoon. So not really seeing the stronger sellers there. If we take a look at the advanced decline line, yes, it is in trend lower zone. That is bearish. The index score is bearish as well on Friday. So we have to give credit where credit is due. We can't just like cherry pick here. What else is going on? You can see on Friday we have a bearish cumulative build out of the tick also. So there's some bearish things going on, but so far, based on the evidence I can see, it's not enough to get me back into the mindset of, oh my goodness, the election gap's going to close, the market's going to fall apart to start the new year. I'm not seeing it. I'm still seeing the opportunity, as we were just talking about here, for this to hold as a potential higher low. And once again, please don't misinterpret my analysis here. Am I going to be just like trying to long this, buy as this moves lower? No, not really. Not underneath the 590.75. So that's the key level. That's the must hold. That's what we talked about in the intro. Let's jump on over to the market profile to see if we can learn anything else about the ES here, just in general, the S&P 500. This key level at 60.50 remains sort of key into the early stages of the week. Ideally, market profile would start to develop value over that level if we're going to see a stronger recovery effort here. Obviously, on Friday, value was underneath the 2-day range from the, Tuesday and Thursday. Remembering that Wednesday, of course, was the holiday. So that rejection there, it makes sense. It's off of a logical area, and of course, value is lower on the session from Friday. We would need to see that move higher to regain some of the confidence on that upside, which makes total sense based on the S&P 500 SPY cash analysis we were just conducting. The higher low over Friday's high really kicks that off at a value area as well. Poor low on the Friday session could be in need of some repair, F&G period. So if you see a sweep of Friday's low, a long trade I'd be very interested in would be the higher low back inside of range, right? Something that looks like this, very, very interested. If we can repair the poor low, then get a move in the upward direction. If you're not familiar with the market profile and you're like, what is this poor low value stuff that this guy's talking about? Check out the video tutorial in the top right-hand corner, and we'll move back on over to the platform to finish up the broad market analysis with the QQQ, IWM, and then, of course, all of our supporting evidence. Qs, let's go to a weekly chart here. It is, after all, a Saturday update video. What do we see out of the QQQ weekly? Very similar to the S&P 500. Candle structure and location is almost one and the same. Green-bodied inverted hammer, so the same exact indications there. Closing a little bit lower than the 50% mark, but nonetheless neutral on the structure. If we think about the location on the bar-to-bar count, certainly a lower high and a higher low. Neutral on the inside bar as well. What I find most compelling about this particular chart is that this is your key higher low hold, right? You want to use previous resistance as newfound support, and that's still the case here. Stronger sellers would have tried to battle for price acceptance underneath that level, and it simply did not take place. If we come in with the Fibonacci's to be congruent in our analysis, coming from low to highs over the 38.2, From here to here, we are over the 38.2 still as well. If we come in with the anchored VWAPs on the weekly time frame chart for the NASDAQ, we're over the entire cluster. Once again, a little bit more bullish here on the tech side of the market. This has been driving a majority of the gain. So as long as we're over, what's the key level here? Let's just call it out. Roughly, I think the key level I've been leaning into is more so the 514.75 level. As long as we're above that, I really don't see an issue with this market, and it is great confluence out of the weekly chart currently. The trend count is obviously up with lows, higher lows, firm higher lows. This was a soft higher low. This is clearly going to offer a firm higher low in the upward direction. We don't really have any concerns about a soft lower high developing yet on the weekly time frame. If we just clean this up and jump on into our volume profile on the weekly, and again, we can just fare with a 6-month chart is just fine. What do we see here? Any rejections of the high volume node in the upper wick? A little bit, but it's not as clean as the S&P 500. I would really say that the S&P has more of a chance for a firm reversal on the daily in particular, and we'll change our tone to being down when and if that head and shoulders is in play, but not nearly as bad here in the QQQ NASDAQ. So let's take it on down to a daily chart, back to the QQQ. We'll firstly evaluate this week's expected move. And obviously, folks, I know I didn't mention it in the intro or even in the S&P analysis, but the market's closed on Wednesday. So here's the same thing, the weekly expected move. If you're not familiar, you can check out the tutorial again in the top right-hand corner. The upper bound is at 531.95. So this is a 4-day trading week. Full 4 days, though, not a half day on Tuesday. 531.95, equal high to last week, very similar to the S&P 500, a little bit more neutral than anything else. It's not inherently bullish. If we're contained by the lower bound, we have 513.08. I would probably still call for that to be bullish here. Again, there is our daily higher low line in the sand. What was I off by about 10 cents? I think I said 14.75 on the weekly chart. It's technically 514.85 based on the original pivot high from back here. Regardless, I do like the weekly expected move maintaining the overall uptrend on the daily time frame here. There's a lot more chop and slop happening in these key levels. So you've got a lot of gray dotted lines instead of the thicker, or I should just say firm, solid levels that we have here. Walking forward, I really think we want to keep it simple over this area right here, and we'll see why. It's primarily coming from the Friday high, and then of course the Tuesday low. Even Thursday's low was very close to that area. Over 524.75, we're looking for the uptrend to continue, and over time we're looking for the all-time high. We don't have nearly as much overhead supply as we do in the S&P 500 at this 533.25, so I would not put as much emphasis on, oh my goodness, we need to reevaluate the chart here. It's got to crash and burn. It's a huge opportunity for a lower high. Not nearly as bad on the QQQ NASDAQ. Anything that's chopping around in this range here is exactly that. That's why we have these gray dotted lines. It's kind of choppy. It's kind of sloppy. I'm not really convinced that it's an easy short in there. And the primary reason for that is because of the daily higher low line in the sand that we were just describing here at 514.85. No reason to change your tone aggressively if the NASDAQ is over that level. Now, of course, if we're under that level, that's a different story, right? And we'll start talking about how any consolidation under this really starts to fail where? Underneath the Friday panic gap down low, breaking the daily 50 SMA. That's where things get much more dangerous, and we can start to look for this. I really do believe, even if we, let me zoom out on this. If I just go back to this previous all-time high, even shorting into that previous all-time high underneath the Friday low from 2 weeks ago, I really don't know that that's a great idea either here in the QQQ NASDAQ. So I would maintain the bullish stance on the tech side of the market here, and I would not try to prematurely call the change in tone on the daily chart or even the weekly chart so long as we're over. I mean, the absolute line in the sand is at 503.25, but I'm paying meticulous and very close attention to 514.85 for our daily trend to remain up, right? We want lows, higher lows, soft higher lows here, obviously a firm higher low. It would be great if the next firm higher low based on an hourly downtrend, which we did build on the Thursday-Friday interaction, maintains acceptance over 514.85. So keep it simple here. Wouldn't really get overly involved in this box. I would think that this is your path to the upside. Maybe a pullback higher low and a Brigade bolt back in that range gets you to the all-time high. We'll have to change our tone if we really start falling underneath 514.85. But again, big bearish tone? Probably not. Probably more so neutral. Maybe we get some scalps into this level down here. But would I be like an aggressive bear until we're actually underneath the previous all-time high? Probably not. Just doesn't really make sense from a technical perspective. Let's drop this thing down to an hourly time frame chart. Let's see what we can learn. A couple of things. Of course, we can just see the slop and chop. If you do something that looks like this, technically there's a valid level at 521.25. Technically, there's a valid level here at 517.75. But what are you going to do? Are you going to take a short into these lows expecting that we rotate to here? That doesn't really seem like great risk reward. You need to be like a nanosecond trader scalping that to the downside for risk reward on a 1-minute chart, which, that's fine if that's your mojo. But I really don't think that that's the strong opportunity this week. I'd be sort of neutral in this box for those reasons. So the levels are, they're getting reactions here, but the risk reward just doesn't really make sense inside of this box. And that's really a reflection of the daily analysis that we just conducted. So any acceptance here is a good first step. Again, it might not be an easy long there, but it sets up the Brigade bolt back out of the range over 524.75 to get into this level from up here. Again, this is the origin of the Powell plunge at 533.25. From there, maybe there's a minor pullback. Maybe you could start to build out. And, if appropriate, we'll put this level in. We don't want to get too level happy just yet, but maybe the pullback, supports a higher low here and then starts to go. That's where you're looking for the all-time high. So that's at least an idea to carry forward into maybe the back half of the week if we do get this bullish outcome. Anything that falls back down to the midpoint of this consolidation, you guys know the rules. Don't enter in the center, don't exchange in the range, don't diddle in the middle. It does not make sense to be trading here aggressively in between 521.25 and 517.75. Of course, what does that mean? If we fall into the lower third, this is probably where that change in tone becomes a little bit easier to pull off, and maybe the risk reward here is a bit more favorable, right? This would be a thin structure retracement versus trading in this box. You're really having to battle a ton of these positions from in the past. Okay, so that is the hourly analysis here. Let's jump in with a Fibonacci from the top of the Powell plunge to the lows. Where did we close relative to the fibs? Nothing really impressive. I would say that the most influential component of this analysis with the Fibonacci is just reinforcing this idea here over 524.75. It's possibly going to continue the retracement towards the 100% mark. That would be bullish, of course. If you're underneath the 38.2, it's got to be a bit more of a bear flag consolidation. You're not really getting as much of that head and shoulders pattern that you were getting out of the S&P 500. So I would really say that your QQQ makes the most sense for this. And we will really, really take a backseat on the shorts here and focus more so on the S&P 500 if we're actively looking for shorts in the coming weeks worth of trade. What do we see out of the intraday anchored VWAPs? And then we'll move it along to the internals. Just total confirmation of the key levels, right? Where's the entirety of the anchored VWAP band? Really wouldn't do anything aggressive until it's either this or until it's either this down here. So I think that the QQQ is telling us the KISS method is what we want to focus on. Keep it simple, stupid. Let's take a look over at the NASDAQ side of the market internals. What do we see here? Any big bearish outflows on Friday? Absolutely not. Absolutely not. And even on the Tuesday rally, when we had that shortened holiday session, so ignore the flat line over here, we did close up and over positive 400 million. So what does that tell you? Probably want to lean more so on the bull side than the short side. Now, I will concede the point like we did in the S&P 500. This absolutely is bearish, and this is more bearish than what we would have cut off at the 1 p.m. close on Tuesday anyways. So you're getting some mixed signals here, which I think totally aligns with what we just described on the QQQ. Mixed signals in the box. It doesn't look like it's an easy short per se. The longs get way more attractive on this move back like this, and I think that's what we're going to wait for here out of the QQQ NASDAQ. Let's take a look at the market profile for the NQ, see if there's any major differences from the ES. The answer is not really. Notice the A period single prints. That, of course, is indicative of emotional selling. So very emotional. This is a B-shaped profile. This is long liquidation. This is not really an indication of new money sellers getting active in the market. We do still have this incredibly poor low on the Friday session, so any sort of open that comes in and sweeps the low with a higher low back in range, something along these lines here, bullish, count me in, coach. If we're looking for a higher low back in range, then we're looking for that rotation in the upward direction. Ideally, value would do what? Just like the S&P 500, what you're looking for is the value area to migrate up and over 21.8. 21.8 early on in the week will hold the key out of the NQ futures. We've been talking about this level till we're blue in the face for the last week and a half out of the pre-market preps, right? So there is your NASDAQ breakdown. Let's take a look now back on over to the platform here at the IWM small caps, because this continues to act as the headwind for the broad market. It's just not, it's not playing nicely with the other kids in the sandbox, right? If we're thinking about the weekly structure here, what do we see? definitely the similar style, inverted hammer, green body, a little bit longer of a lower wick, a little bit smaller of a body relative to the upper and lower wicks compared to the NASDAQ and the S&P, but still a troublesome candle. And really, it's not so much the bar-to-bar location. Again, it's technically an inside bar. I will say that this is under the 50% mark in terms of retracement of the larger red-bodied bar that preceded it. However, adding in even more context, we know that the issue out of small caps has just been the failed breakout of this weekly zone. Right? Previous support did not act as support. We're not holding a higher low above. As a matter of fact, the upper wick on the weekly bar is suggesting that the sellers are actually building an edge there, right? This is a sort of one of these lower high Brigade bolt. And, I'm not calling for this week, oh my goodness, we have to come down to $200 on the IWM, but it's certainly, it's a reasonable possibility over time as long as this failed breakout persists with lower highs underneath 227, which is what we know as the key zone. If we come in here with the Fibonacci's from the bottom of the election, candle up to the top, obviously this is a 100% retracement. So is the market still thrilled about the, slashing of regulations and oh my goodness, America's open for business, we're going to get a ton of mergers and acquisitions done, it's time to do deals? I mean, small caps are not really suggesting that. I think that you have two promises, right? And this is something that we'll talk about in the 2025 Outlook report. You have two promises. From the incoming administration, you have deregulation, but you also have from the Fed, or at least you had from the Fed prior to the updated SEP back here, you had rate cuts continuing throughout 2025 to the tune of 2 rate cuts that's what the new updated SEP comes in at. But before that, we had 4 rate cuts. So both of these promises need to sort of come back to fruition if the small caps are going to play nicely with the other components of the broad market. So really concerned about 227 basically on the 100% retracement. It's not uncommon for a lower high to be set before some sort of breakdown. So further consolidation in this range would not be unreasonable. Let's take a look at the anchored VWAPs on the IWM weekly chart. And a couple of ones, we're probably going to have to start to anchor something to up here. But generally speaking, notice the closures right at the top end. That marks the top of the sort of breakout zone, right? And the bottom of the breakout zone. That's already in jeopardy. And classically, if you're using candlestick technical patterns, this is just a bearish 3-bar play on the weekly chart. Anything underneath the lows sets up continuation, right? So not really in a great looking situation out of small caps here. If you come in from the bottom up to the top with a fib, you're underneath the 38.2, which was confluence with this area. Ideally, if this was going to be bull flag consolidation, you wanted to hold here. That's not happening. Underneath the 61.8 probably gets dangerous to what? The anchored VWAP, and much closer towards that 200 round number that we were just talking about moments ago. What would change my tone out of IWM? What would be oh my goodness, forget about all that bearish stuff. It's back on the horse, back on the bull. We're riding this thing back up to all-time highs. It would have to be not just a weekly bar that gets over this, but probably closes above and then gets consolidation or some sort of, supportive candlestick structure that would indicate that this level has been recaptured on the bull side. Then we'll look for the all-time highs. So you're probably talking about, at minimum, a 2 to 3 week turnaround period here before small caps get back into a more constructive look from a candlestick perspective on the weekly. Now, of course, if the weekly bar does this, I mean, undoubtedly we'll have to change our tone, but that really seems like a lower probability outcome based on everything that we're looking at in the market currently. Let's take this off. Let's drop it on down. We can look at the volume profile here. Why not? Let's take a look. And on this one, we actually do need more time, not less time, but more time because of the way that the 2021 sickness recovery and then COVID drawdown. Oh, I said the word. Happened over here. So right back down at the high volume node, the market should be comfortable and find an equilibrium at this spot based on the number of transactions that have happened here in the past. If we start getting over that, that's once again where you get a little bit more confident. If we start pushing away from it to the downside, I really think it's as simple as that, right? You've got a failed breakout of this 227. If you remain below, I think the odds favor moving away from this high volume node, which, where does that bring you? Back to 200 from a high volume node perspective as well. The top end of the big balance range from back down over here. Could we maybe be getting something like a big monthly retest higher low for this? It's possible, but of course, in the interim, it's got to be a headwind for the S&P 500, right? So there's your IWM higher time frame analysis. Let's drop it down to the daily. Let's see what we can see over here. I mean, just very, very different from what we're seeing in the other markets, right? Where clearly you're not even close to maintaining some sort of daily uptrend or getting back into one. This was the punishment before the Jerome Powell plunge. Remember that markets crashed from the lows. We're well underneath the daily 50 SMA. This is that weekly breakout level at 227 we were just talking about. The weekly expected move does not forecast a move back over that. It doesn't really forecast a new lower low being brought in either. I'm sort of I think that that's a little bit of a mispricing here from the options market, noting that usually range compression leads to range expansion, right? So when this break comes, I don't really think that it's going to respect the weekly expected move from the options market. So just keep that in mind. Generally speaking, if price remains underneath 227, has to be a headwind for the S&P 500. If price can get back above, we'll change our tone. We'll look for the 50 SMA to act as the next target. One thing I do want to point out here on the daily time frame chart before we drop it to the hourly is just the fact that on Thursday we closed pretty firmly up and over this 224.25, and then on Friday there was not nearly as bad of a quote gap down on that Friday open, right? Whereas the NASDAQ and the S&P opened right at the lows of the Thursday session, you'll notice that in the IWM, small caps opened right at the key level. So the concerning issue with this chart is, okay, if we had stronger sellers, ideally, where would they have held up? They would have pushed for price acceptance in the upper third, upper 50% even, of that Thursday range, and then looked for the breakout to hopefully recapture 227. Did that take place? Obviously, the answer is no. To me, what does this start to signal? Well, the daily pattern is a look above and fail. What's the target on a look above and fail? Always the bottom end of the range. That would be 218 here on the IWM. So it's a bear flag. It's bearish until proven otherwise. I would not be overly constructive on small caps. And once again, this has to have some influence over the S&P 500. And therefore, if we're looking for shorts in the market, I think the S&P is the place to be. If you're looking for longs, it's got to be the NASDAQ, right? Let's take a look at the Fibonacci on the daily chart before we drop it down to the hourly from here to here. Well underneath the 38.2. The weekly lower high threat is underneath the 38.2 as well. So not really seeing a clean path forward from that perspective here. Here it is on the hourly time frame chart. Let's just take a look at the Powell plunge with the Fibonacci's. Let's try that one out. From, of course, that Wednesday topping action to the Friday gap down low, we've closed back down underneath the 38.2. Once again, this is very classic bear flag consolidation. You could see it as clear as day when I zoom in even further. We just want to make this big and center on the screen, please. Thank you, Thinkorswim. This, even if you just want to consider it a balance range, forget about the bear flag component above, look above and fail. So now any lower highs that sustain themselves underneath 224.25, it's not an easy chart to navigate in the upward direction so long as you're underneath that level, really underneath the 227. As you can see, it's an issue for small caps. It's an issue for the S&P. Shorts the S&P, longs the QQQ. Really think that's how you want to simplify the trading into this upcoming shortened holiday week once again. Hopefully things return back to more of a normalization as we get closer to January 6th, right? Here is the anchored view app spread. You're getting confluence out of the weekly lower high. You're at the midpoint of this range once again. Is there an easy trade that sets up in the midpoint? Probably not. Just like the NASDAQ, don't enter in the center, don't exchange in the range, don't diddle in the middle. That's 221.50. If you're just tangled up around it, I would not try to be a hero in the range. Maybe there's a scalp that looks like this, but again, please reevaluate at 227. This to me probably is the higher, that's the better outcome to trade for, just noting this failure to break out on the Thursday session, right? So the lower high being a double top rejection or something of the sorts off of 224.25. All right, all set on small caps. Let's take a look at the Rusty Russell internals. What do we see over here? We did not have strong volume outflows on Friday. So this is noteworthy though. On Thursday, when the market broke out of the top of the range, did we have strong volume inflows on Thursday? No, we did not. So that was not a very trustworthy move. Thursday did rally from negative territory to positive, so we'll give credit where credit is due. But again, look at this. Bearish on the Friday action. Bearish on the Friday action, even the cumulative build for the Rusty Russell on Thursday, as we're basically rallying all day in the rut. No love out of the cumulative build there, so not really feeling it from new money buyers stepping into small caps with, of course, the change in tone from the Fed last Wednesday, right? Or what would it be now? 2 Wednesdays ago. Let's go ahead and take a look quickly at the Rusty Russell market profile, and then we'll take a look at our sectors and all other supporting evidence. What do we see here? Notice that as we were breaking out on Thursday over those equal highs, technically the value area and the point of control did migrate higher. All that ends up looking like in hindsight, of course, is now we have overhead supply, value accepted lower, point of control is definitively back inside of that range. These players were not rewarded, right? And one small takeaway, and this is something that you can carry forward in your own trading. So I figured, let's do this one on the IWM, or at least the RTY futures. Look at the M period spike. What does that tell us, right? We have buyers who are trapped up there. As we open, where's the A period open? Open for A periods down here. That is a pure play spike rejection on the Friday open. So Longs are trapped at the high of day based on the M period spike. That's an emotional move. They are not rewarded, and A period does not recapture the base of the spike, and then the market sells. So your spike rules, there's a good example of it on Friday from our good friend, the Rusty Russell. Let's get back on over to the platform. Let's take a look at, of course, none other than the supporting evidence, moving through the sectors first, and then, of course, everything that follows that. Weekly performance, who was leading, who was losing, and where was the weight? We have semiconductors leading the pack. Wow, that looks risk on, doesn't it? Maybe this guy's not crazy for thinking that this might actually be a reasonable outcome, then looking for a move into the all-time high. Just might be, with semiconductors leading the pack. That is a heavyweight risk-on component of the XLK subcomponent, right? The XLK, though, heaviest weight risk-on sector of the S&P 500, closing a little bit lower underneath the S&P's performance. You can see down here 52 basis points. Then we have energy. Then we have financials. What really gets me most excited about seeing the XLF up 1.44% is that this market's still rotating, right? You're seeing tech lag by just a little bit. It's not crazy to the downside. It's not like they're selling tech aggressively, but you're still seeing a market rotation. And what do we know about markets that are rotating? They will likely continue in the upward direction. At the bottom end of the barrel, it's the TLT. Bonds are getting absolutely crushed as yields continue to move in the upward direction. And materials. Materials are the lightest weight and perhaps most insignificant sector for the S&P 500. So are there really any issues with the sector posture here or performance on the weekly perspective? No. Absolutely not. Let's check in on these structural charts now. And this is where things get a little bit, you can get a little bit more into the weeds about this. So did semiconductors, although they're up 2% on the week, did they do anything impressive? Not really. I would just say that, okay, they didn't break the bottom end of the range. Gold star for you, check mark. Great job. You did your homework. You didn't break the bottom end of the range. But did you go above and beyond? Did you do the extra credit? Did you break out of the range to the upside? Absolutely not. So still have to take a little bit of a cautious stance here inside of this balance range on semiconductors. This really gets going up and over 256. I like the fact that on Friday, we do have a hammer holding over the midpoint. It's not quite exactly 50%. It's much more so respectful and indicative of all of the structural rejections and supports we've seen in this range. So 245 could be a good launching point for perhaps consolidation in the upper portion of the range, which then gets us this over time. One step at a time. It's another shortened holiday week. Manage those expectations, but at least it's not bearish. As we take a look at energy, speaking of bears, my goodness, this looks absolutely awful, and one of the trade ideas we'll have towards the end of the video really leans into this. Look at the lower high rejection underneath 85.25, the bottom end of this balance range here on the Friday upper wick. To me, it looks like energy, XLE, and your oil stocks and whatnot can really see a continuation to the downside into some of this deeper demand over here, closer to 80s. Now, luckily for the S&P 500, this is not a heavyweight risk-on sector. Might have some things to do with that global recession we've been talking about ex-USA, because the U.S. is not showing any signs of a recession whatsoever, by all of the metrics, basically. If you just objectively take a look at the data points, not an, oh my goodness, I see all these big bearish headlines. No, look at the data points. U.S. is not on the cusp of a recession. It's just not. Could that change over the span of the next couple of months? Maybe, but as of right now, data in hand, no recession here. Global recession? Sure. Let's take a look at the XLF, because this, of course, is one of the culprits for the rotation thesis that we were just talking about. It looks okay, but I would say, like the SMH, it doesn't look great per se. I like the fact that it's holding the previous all-time high and it's not closing the gap all the way. What that tells me is that stronger sellers are not getting involved, even in the aftermath of the Powell plunge. I also like the fact that this is trying to hold back over what originally was the gap up from, I believe that was what was that? That was the election gap up. That's the election gap up. This was like JP Morgan earnings and then all the big banks reporting, right? Breaking out of that range. So this election gap up, recapturing that move at 48.70. If we can get consolidation here, I think that's great. That's healthy for the S&P 500. But what's the big threat, right? You need to get back up and over the neckline of the head and shoulders. And that, my friends, right here would really continue the rotation theme for the S&P 500. 49.60 would be your key watch. So as of right now, it is not inherently bearish. I like the fact that this is holding. If we get this consolidation, we're bullish to neutral. This is bulls on parade. If we fall back down to an equal low, that's where I would be concerned. Underneath these lows, okay, yes, we have to acknowledge this, of course, is a lower high, and now we're in a daily downtrend. Gap fill reversal would be the next target, but intra-week, it's undoubtedly bearish pressure for the S&P. We're not there yet. We have a little bit of indecisive action on Friday. I would tend to think that this consolidation and then learning something here or here sets off the next move. Next up, healthcare sector really getting beat up This has moved from the over the span of like months, right? This has moved from the second heaviest weighted sector all the way down to the fourth heaviest weight sector at this point. So it has less influence over the S&P 500 than it once did. And it's also still D for defensive. So sort of ironically, as this gets beat up, it actually becomes less and less of an issue for the S&P. Weird to think of it that way, but it is technically the truth. As long as we're underneath this level, 140.80, I have to remain a bear. There's just no way, right? Previous support turns resistance. There's no way to be bullish under those circumstances. If you were to get a recovery and some sort of thin structure retracement, I'll change my tone, and perhaps over time, I'm not going to call for this just yet, but maybe there's an inverted head and shoulders, which causes some cooling off from the selling pressure, at least out of healthcare. We're not there yet, but that would be the watch. As of right now, it's bearish pressure until proven otherwise. I would really just expect the downtrend to continue here out of the XLV. Until there's some sort of updated catalyst, maybe it's the earnings season upcoming, not really seeing a reason for healthcare to just magically rally out of this low, right? It to me seems like bearish consolidation. It's been beat up. Nobody's really interested in this sector right now. And again, ironically, because of that, it actually has less import over the S&P. Let's move along to real estate. Not a surprise here with what's going on with interest rates breaking out. Big move to the downside, getting this consolidation. It's got to be downward pressure is downward pressure for the S&P, but is it really going to sink the ship? No, it is not. Let's take a look at the XLU utilities. Again, downward pressure is downward pressure. This is a D for defensive sector. It's also L for lightweight. This lower high is bearish pressure undoubtedly for the S&P 500, but being defensive, being lightweight, is it going to sink the ship? No, it is not, right? No, it is not. So consolidation down here is fine. It is absolutely fine. Let the daily 200 catch up. Maybe then we get some sort of rotation where, okay, we get financials cooling off. We get the tech sector cooling off. If utilities can play, catch up a little bit off of the daily 200, you'll probably still get a pullback in the S&P 500, but it's not going to be a disastrous one. You'll still be getting a broader rotation, right? So that's the thesis there out of utilities. XLK looks okay. Looks okay, but not great. I do think that the equal highs flat across the top do not represent the proper end of the auction. To me, that's that's the equivalent of sort of a poor high, if you will. So looking for some sort of move back into this area and then for some sort of euphoric breakout, blow off top over that, if the auction is going to end properly and put in more of a capitulation top. As of right now, it's just not the case. Where it's not even close, right? So I would maintain more of a neutral stance through here, and I think that's echoing the sentiment of what we had in the QQQ. Moving along to discretionary, no issues out of this chart. As we all know, it's been on absolute fire, breaking out to the upside with Amazon and Tesla pushing new highs. So is there any concern here? No. Is this technically bearish consolidation for like an hourly bear flag? Maybe. Would I be bearish the sector though? No. Again, any sort of pullback that holds daily 50 SMA, this previous breakout high, all set as long as we're over 219.75. If we start to retrace below that, obviously we have a level that's going to come in, closer to what, 202 maybe? Yeah, 202. We'll bring that up when it's relevant, but I mean, come on, guys. We're just hardly pulling back in this range here. I would say that this is still bullish, pulling back from the highest high, looking for continuation in the upward direction. Call this like some sort of daily double bottom over the neckline, and you're back off to the races at 234, right? So still maintaining the bullish posture here in discretionary, not an issue for the S&P, XLP. This is consumer staples. We were just on discretionary. Lower high underneath, not so compelling. Bearish pressure, yes. End of the world for the S&P, no. Lightweight, D for defensive, not going to move the needle. Just like the XLU, if these other heavier weight components, I'm talking about financials, I'm talking about tech, I'm talking about discretionary, if those pull back and consumer staples wants to do something like looks like this, that's going to continue to fuel that rotation that we were just talking about. So still watching that thesis there around the 80 handle on the XLP. Communications looks fine, very similar to the XLY, where I would say that this is still just a higher low pullback, daily 50 SMA catching up over $100 again, gets it flying high towards the all-time high. Anything underneath that, I would still look to be bullish on the gap fill reversal. I would change my tone underneath the gap fill reversal, 93.20. Is that in play this week? I don't really foresee that. XLI, industrials, lighter weight, about 8% now. Bear flag consolidation, sure, downward pressure is downward pressure. Have to acknowledge that it isn't a downtrend well underneath this previous low, lower low, high. Technically, lower highs will easily be set anywhere underneath the daily 50 SMA. So kind of not as great looking for the S&P compared to some of the other sectors. We'll keep an eye on it, but it's not one of those heavy hitting sectors as we know. TLT, I still maintain my short put position at 85. I'm more than fine being assigned at 85. That was one of the intentions, but if they expire worthless, then that's great as well. These go out to February, FYI. If we see some sort of continuation there, obviously the short puts will start to get beat up a little bit. I just want to be transparent whenever I have some sort of swing on. It's very, very rare that I do. Very, very rare, but I do in this case, so there you go. What do we see out of the technical chart? Obviously, it's breaking down underneath this low, which would just be your inverse to the TNX, which we'll talk about in just a second. TNX does look like it has a path to 5%, which probably means the last time we were at 5%, the TLT was where? Closer to like 82.25 down here. This is when the 10-year was trading at 5%. So if that happens, then fine. But once again, what's the longer term play? Either farm the yield or look for a literal price appreciation out of the shares in the upward direction. XLB Materials, what's going on with the lightest weight, most meaningless sector? It's hurting. It's absolutely hurting here. And I think that what this might tie mostly into, and we could just do this real quick. Let's go XHB for the home builders. And let's go ahead and throw on here. Let's see if we can put on a comparison line of the S&P 500. SPX is fine. Good. Let's throw that on. So what I want to get at here is that we have a pretty big divergence out of home builders right now. And this is not something we talk about often, but we know that home builders really reflect more so that cyclical side of the economy, right? It's not only, a new build gets design involved, architecture involved, it gets literally the construction involved. And then you have interior design, furnishing that home. Like there's a lot of new money flowing into the economy when home builders are doing well. So something to maybe counterbalance maybe that overly aggressive stance we had over on energy about, hey, what recession over here? I mean, home builders aren't really playing nicely, and we know that this is a function of interest rates, of course. Nobody wants the mortgage, at a 10-year at 5%. Good luck with your mortgage being at 6-7%. It's just not good, right? So, of course, home builders getting beat up is a small bearish divergence that we would want to focus on, but obviously you can see here that as this divergence has played out in the past, I mean, it was not like it does not have to be a one-to-one every single time that, oh my goodness, it needs to result in an imminent crash right here, right now. It's something we should talk about, but it's not enough for me to go out there and start slinging shorts with both hands in the S&P 500, right? So that's that. We're all set on the sectors. Let's take a look through the actual ratios now and see how the relative strength and weakness is playing out. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. This still looks risk on. This absolutely looks risk on. This looks okay. It would be best if it could curl up over the 50 SMA, the gold moving average. This is not a concern. This is not a concern over here, and this is not a concern over here. So even as the market goes through this volatile time frame, you're not really seeing a flight to safety risk off style posture from the sectors, which is what we talked about in the actual percentage change performance as well. As we look at this, and now again, look at our handy little labels so you know exactly what these ratios are. This is bullish and risk on, bullish and risk on, bullish and risk on, bullish and risk on. We're 4 for 4 on the risk on sentiment. Now, 6J down here represents the Japanese yen futures. This is the August 5th panic. We did get huge economic data out of Japan on Thursday evening, and the Bank of Japan, of course, they didn't hike rates implicitly on, Thursday of last week, but they implied, I'm probably misusing the word implicitly there, they implied in their summary of opinions, is what it's called. That's their equivalent of the SEP. They implied in that document that it's very likely over time rates will move higher to sort of counterbalance some of the hot inflation that they're seeing. Even with that comment, did the Japanese yen go on some sort of tear in the upward direction? The answer is no. So would I look at Friday's sell-off and say, oh my goodness, the yen carry trade is back. It's got to go to zero. This market's going to flip risk off. It's going to unwind a ton of leverage. No, it's not happening based on what we see right here in the actual yen itself via the futures, right? Let's take a look at some other indications here. Speaking of currencies, let's jump into our very own dollar. This is a weekly time frame chart. I've adjusted the time frame so we can see this relative to the previous highs in the long-standing range. We are breaking out, which makes sense with interest rates on the move in the upward direction. This, of course, should in theory act as a bearish headwind for the S&P 500 as the fundamentalists pound the table. The technicians, right, as we're looking at the technical indications in the S&P 500, are saying no, it's not going to crash and burn and go to zero, but there is a disjoint. Like let's not ignore that, right? Let's go to gold, expressed as a currency, right? So you can see that there's no flight to safety happening in gold. Nobody's rushing into gold because of like, oh my goodness, inflation and your money's going to be worthless. That's not really happening. Gold is consolidating more so than anything else. As we take a look at interest rates now, And what I've done here, folks, is this is the daily, this is the weekly. We no longer have the S&P down below, which is fine. I think the comparison really that needs to be made is, once again, here's 5% on the 10-year, which means TLT at like 82 roughly. But if you do something that looks like this on the weekly, we know that we've talked about the break of this resistance trend line that then started to fail. Now we're back above, and we've even cleared that weekly high, which is this weekly high from back here. So what's the next big step? Obviously moving back closer to this sort of zone over here. Oops, I'm trying to get my crayons working, right? That's the next target, right? That would be up here at 4.7 on the 10-year. And then beyond that, it's pretty smooth sailing into 5% on your 10-year yield. So the point being is that if you're evaluating the trend on the weekly time frame chart, you have a path to 5%. If you're evaluating it here on the daily time frame chart, you have lows, higher lows, higher lows, higher lows. This is a high. You've exceeded that. You've made a higher high. So even if this pulls back, it could afford a higher low at 4.5. Continue the rally, it could afford a higher low at 4.3 and continue the rally. So I really do believe that interest rates moving in the upward direction is a theme we should be paying attention to and prepare for into 2025. Let's take a look at the inverted ZT, which of course is just the Fed tracker tool. What I find most interesting about this, it runs parallel basically to the 2-year yield, right, is if this breaks out, it's basically telling us that instead of expecting one rate cut in 2025, we might have to, I know this sounds insane. I know it sounds insane, so don't get crazy in the comments with me. We might have to prepare for an emergency Fed rate, dare I say it, hike. Rate hike. I know, it's like astonishing to even have those words come out of my mouth, but if the 2-year breaks out, the 2-year leads the Fed by the short hairs and says, this is what you're going to do. And if you don't, you're going to run into trouble. Right? So I would really pay attention to this equal high here, and things get a little hairy if that breaks out. Let's continue along and let's take a look actually at the Fed tracker tool now. We'll rip through the fundamental analysis here. What do we see? This is that single rate cut we were just talking about. Really, the SEP outlines 2. The market's pricing in 1. One of the bullish narratives that I think we'll talk about in the 2025 Outlook report is that the SEP promises 2 rate cuts. The market's only pricing in 1. If the market starts to price back in total the 2 rate cuts, what does that do? It probably sends markets in the upward direction as yields come down a little bit and ease some of the pressure. So a little bit of like, it's like, okay, what does it do today? What does it do tomorrow? What's the next CPI report? What's the employment situation looking like? You got to monitor it on a day-by-day basis, but at least you'll have the understanding of why potentially the market might rally if we start pricing in more appropriately 2 cuts instead of 1 from the SEP, right? And that would require improvement, namely on the inflation metrics, CPI, PCE, PPI, not so much the labor market, right? The labor market's fine right now. It's inflation that poses more of the threat. Let's take a look at the calendar. Once again, we talked about how in the Thursday session in the afternoon, we got all those big components from, the Japanese central bank, the Bank of Japan. You can see that CPI misses the expectation here at 2.5, but it's over the previous read. So better than expected, but still not moving in the right direction. Japanese CPI seemingly indicating that inflation in the economy is starting to grow there a little bit more so, meaning that their policy rate might need to start moving away from, basically, hey, borrow from us and we'll give you money, right? So that's the yen carry trade in a nutshell, FYI. So what actually was released in the summary of opinions? One of the things that I really think we want to lean into is this second bullet point right here. You can see that inflation has been steadily increasing while the risk of the bank falling behind the curve is limited, right? The bank will likely decide to raise the policy interest rate in the near future, but not right now. So I think what we need to prepare for is, okay, they've given the market the understanding that rates will move in the upward direction. This will not be a shock based on how they've prepared the market in their summary of opinions. This is very similar to what Jerome Powell does in all of his press conferences, right? With the updated SEP, he basically telegraphs to the market, hey, this is exactly what I'm going to do. Please do not be shocked when we make this policy adjustment. The Bank of Japan is taking a page from Powell's book. Why is this important? Because if the market knows that a rate hike is coming, then the yen carry trade is not going to blow up. And you can even see as I scroll up further on this page, right? Look at this bullet point right here. I mean, the Bank of Japan is not ignorant. They know exactly what's going on here. Yen carry trade positions have not been built up. They are not seemingly worried about it. So, do I really think we have the risk of that big unleveraging unfolding causing NVIDIA and all those high flyers of 2023, 2024 to unwind? Not really. Not really, based on the yen carry trade. That by itself is not enough of a reason, right? Let's take a look at the upcoming week in terms of fundamental data. What are we getting here? Looks like we get some PMIs. We can unfilter for JPY currency here. PMIs from Chicago, HPI, House Price Index. Obviously, New Year's Day, unemployment claims will be the big Monty. It always is. That's the normal Thursday stuff. Manufacturing PMIs, not really all that important. It's the services PMIs on that we're concerned mostly about, which I have to imagine would be the following week. Yeah, here it is. ISM services Monday, January 6th. When markets return to normalcy, it'll be the full labor report as well, with the unemployment rate, ADP non-farm, as well as hourly earnings here. That'll be the big Monty. So really, January 6th brings us back on track for a busy week from a fundamental perspective. What do we see here on the earnings calendar? A big week of absolutely nothing. Is anybody shocked? It's been this way for a little while. Let's get back on over to the platform. Let's finish up our analysis through the additional risk on and off indications. No issues, no flight to safety in bonds right now. You're not seeing any concerns there. This, of course, continuing to migrate in the upward direction. It is just an indication that the Fed is, of course, having to be worried about inflation. And as these move higher, it's really just a reflection of that single rate cut being priced in from the Fed tracker tool, not the two from the SEP. If these roll over back into downtrends, that's where the market probably starts to rally more aggressively, under the premise that the two rate cuts are back on the table. Let's take a look at the credit spreads here, which remain elevated. This is something that we should pay attention to. Ideally, after, of course, the big FOMC plunge, these should rotate back in the downward direction. They're not. You're getting a little bit of that higher low hold here on some of the volatility from Friday. So keep an eye on it. If these continue to maintain their higher lows, just understand that volatility probably isn't going anywhere anytime soon, right? So these volatile ranges that we were not used to previously, right? This is very, very tame market trading ranges, basically, very, very small. This elevated volatility is a reflection of these credit spreads being expanded, right? It's all interconnected, basically, the way that this works. HYG, these are junk bonds in isolation. Still a big bearish divergence if you count from here to here and here to here. However, one thing to point out is that we did get a little bit of a lower high. It's much more severe in the HYG, but this to this higher low wise is at least supportive that the counter trend rally can continue until proven otherwise back into an uptrend. It would be best if this wants to come up to make an equal high. If that were to take place, if the HYG prints 80 in the coming weeks worth of trade, probably looking for a new all-time high breakout. And that, of course, would signal much more of that bullish resumption of the weekly uptrend, daily trend flips to up that we were talking about through the S&P analysis. You can come in here with the LQD and do the same thing in case you're a non-believer. This does not look great. You have more of an equal low across the board here. This is much more of a severe lower high, so you would need improvements out of LQD if you're going to maintain that same exact thesis as what we just covered in the HYG. Let's take a look at Bitcoin. Digital gold is telling us that it might be in store for a little bit of a pullback, right? The Shiller, but rather the Sailor Schiff ratio is actually signaling a little bit of a downside move here. Now, this does not mean short the Bitcoin. It doesn't mean short Bitcoin into the ground. It just means that a pullback might be imminent here as we pull back from literally the all-time high, that big $100,000 mark breakout, right? So a little bit of a pullback here might influence markets in the downward direction slightly. From a risk to appetite perspective, it wouldn't be bullish, right? Let's take a look at total breadth. Breadth continues to be an issue for markets. A little bit of a sideways flat tick, small uptick out of 200 SMAs, a little uptick out of the stocks making new highs versus lows, but still well underneath the zero line. This needs to see an improvement if we're going to maintain more of that bullish stance, making new all-time highs, right? It's been a big theme in the market, that bad breath, for a little while now. How did we fare on the SPX A50R? Remember we were talking about oversold down here at 0.2. We did actually see a little bit of that rebound. So that is making sense, and it is continuing to be fuel to the fire. If this double bottoms out over the neckline, basically, you can assume that your broad market's probably seeing improvements back up towards the highs. So if we could maintain a hold over this towards 50%, big improvements from a breadth perspective. RSP has a lot of work to do. It did not break out over its equal highs in here. So one of the things that you could watch this week is if you're looking for the market to make an obvious improvement, you want to see 178 breached in the upward direction out of the RSP. And at that, you're probably just looking for a retest of the trend line. You're looking for the Powell plunge origin at 180.25, but that would be helpful for the narrative that breadth is back to expanding, which would help the move in the upward direction. So RSP will be a watch for that. If we take a look at the QQQE, what's going on with the NASDAQ equal weight, you can continue to see how you're just in the midpoint of this range from back over here, whereas the NASDAQ weighted is still over this previous high from there. So a little bit of a concern out of NASDAQ, but once again, if we want shorts, I really think the place to be short is the S&P. The place to be long is the NASDAQ. This divergence alone is not enough for me to go out there and short the NASDAQ with both hands. Dow components underneath this big breakout level, huge failed breakout, not really looking great from a breadth perspective. Again, this ties into the narrative that we've been talking about breadth-wise for quite some time. No issues on that. Here's the VIX. The VIX is collapsing back down after its big Powell panic, if you will. Reason that this is important is we talked about this on the last Saturday's update. As the VIX moves lower, even as the market's moving lower, you can generally, sort of conclude that this may have been a capitulatory bottom, right? And that's it. That's it from the market down here. So I do like the fact that this rolled over more aggressively into the close than the S&P did, rallying back over the high. It would be best if this continues to move underneath 15. If we take a look at the VVIX, let's have ourselves a look over here. It's still rejecting, right? This 103, which is a pretty key area from back in the past. As long as you're under 103, you're sort of out of danger zone. This is like, okay, you're on alert. Over 120 is like, whoa, that's the danger zone. So right now, just no issues out of VVIX. If we take a look at the volatility posture out of volatility futures, a little bit of a move towards towards backwardation, but not even close. You're still well over the zero line. And we talked about this inversion happening over here as soon as it happened, basically, into the Friday close of last week. This was one of the main reasons why we thought that the S&P would move higher over the span of the holiday week, and it certainly has. So that, of course, is helping the case for the bullish narrative. This is the same thing here. Little uptick on Friday out of VIX one day, but still, right at the 1275, not remaining elevated like it did back over here after the August 5th panic for an extended period of time. Let's take a look through the core list of companies, and then we'll get you on your way after 3 trade ideas. What do we have out of NVIDIA? We'll keep it simple here. Generally speaking, we all know that the Head & Shoulders has not panned out. This was a failed breakdown from the bears back over here. And as long as this higher low holds over 135 on NVIDIA, I'm actually thinking long here. And again, as I said on the TLT, I'll always tell you when I hold a small position, I have 2 contracts. It's groundbreaking, right? Oh my God, it's the full portfolio. I have 2 contracts of the 137 calls for NVIDIA that I've held over the weekend here based on the hold of 135. Based on the failed breakdown, I think that this has an opportunity to rotate in the upward direction. If they break down and go to zero, just to give you an idea of how much risk is truly on the table relative to, maybe the portfolio or whatever. If they go to zero, it represents less than a 0.5 R loss. Okay, so just understand, that helps you maybe with my conviction, with the amount of risk I'm taking over here. If they go to zero, it's hardly even going to be felt in the portfolio, okay? So I do think that the hammer on Friday is bullish. I like the fact that the sellers could not get that push underneath the neckline, and I think if those sellers are going to squeeze, it's back up to 140. Over that easily unlocks 146.25. Where does this thesis go wrong? Underneath 135, which is where my stop is. Right? Underneath 135, I'll step aside, and that'll be that, right? So holding 135 is critical for NVIDIA, and that's your daily chart. Well, let's go to the hourly, just so you can see it here on the hourly too, right? Here is, you could call this a double bottom. You could call this a balance range. You could see that we have a break to a new higher high. Pull back, this is a higher low. As long as this higher low holds, that's where we're looking for that rotation back to the daily 50, back to the equal high up here, closer to 140. So there's that. Let's jump on over to Microsoft. This is not looking great, if I'm being honest here. We've got ourselves this balance range. You could even extend this off to the left even further. Recall that there was sort of the competition here between this acting as a higher low, but then also threatening a lower high. It looks like the lower high is winning out of Microsoft. And someone brought up a decent comment in last weekend's update, which was that if I'm being bearish on names like Microsoft, and we'll see what other ones we're maybe a little bit hesitant on through the core list, then it's pretty difficult to make a compelling argument for being bullish the broad market. I don't know how I ultimately if I ultimately subscribe to that direct thesis. I think it's got some legs. It's definitely something to be mindful of, but I don't think that's going to sink the ship here if Microsoft is the only one breaking down. So holds of 429.50 are bullish, for that higher low here to here, holding the daily 50 and the 200, but you're inside of this range now with a lower high. It becomes a sloppy chart to deal with, honestly, and I don't like the hourly move either. I think that maybe you get a Stevie Wonder trade on the hold of 429.50 for the thin structure retracement 438. I don't know that that's like the top priority this upcoming week. I think NVIDIA looks far superior, right? I think Apple, let's just get on over to Apple, looks far superior on the potential higher low hold here, right? This is still the hourly time frame chart, but just notice 253.75. As long as you're above 253.75, what do you have on the daily? A glaring uptrend, a breakout level that's being retested, Brigade Bolt on the daily time frame, right? So I really think that Apple is positive for the S&P. So this is where I start to say, okay, even if like Microsoft doesn't look great, Apple looks good, NVIDIA looks good, Amazon doesn't look half bad, supporting once again off of this 220 on the Friday session. If it can get acceptance over the Friday high, I think it rotates back to the top end of this balance range back here, the all-time high at 232.50. So I really don't see this as a dig through the core list of companies of being like aggressively bearish, right? I think that Microsoft poses a threat, but some of these other names look pretty good with support coming in and buyers stepping up on Friday. It's just a matter of getting that follow through now. Now, will I change my tone underneath 220? Maybe. I would still be a fan of the gap fill reversal long off of the previous pivot high down here close to 214. So I'd still like Amazon long off of this level. Next up, Google. Again, trading near all-time highs. This is a bearish looking chart. Not really. It's sort of failing the head and shoulders, right? So the head and shoulders. Oh, actually, who am I kidding? Who am I kidding? Where was I on Friday? Not paying attention to Google, obviously. So the 190.75 actually does capture my attention from a short side perspective. Under 190.75, 185.25 thin structure retracement target. This is still, I'll admit it, I've still got some feelings for the Willow short trade, the quantum compute short trade. Underneath this, I think gets interesting. So once again, that's 190.75. Okay, all right, I take it back. Google does look like a little bit more of a short, but once again, overweigh that with Amazon, overlay that with Apple, NVIDIA. Microsoft and Google might not look great, but let's continue along. Let's see what the other ones have in store for us. Where would that short thesis be invalidated? Just consolidation here, or heck, even a higher low over 195. Not really interested in an easy long in there. It's been very, very volatile up down. So not thrilled about an easy long there, but the short does play. Let's move along to the metaverse. Let's see what's going on with Zuckerberg's fantasy lands. Caught between a rock and a hard place. Really, really is, right? This is the hard place down below. This is the rock up above. It's got to do something cleaner off of 599 over 607.75, and it just hasn't yet. So I take a look at this hourly time frame chart. I mean, I suppose decent buyers stepping up over the daily 50 SMA, but even if you just trade back into this range, I don't think that's an easy trade. Show me this consolidation, and then this. That's where I play long, right? Risk, reward, ideally back up towards the all-time high. So we'll see one step at a time. 607.75 Teslaverse. What's going on over here? It's got to be bullish as long as we're over that previous all-time high. This is something we talked about last Saturday. Although it looked heavy back here with the inverted hammer, there's no reason to be a bear if you're over the previous all-time high. And this also aligns with what we just said over on the QQQ NASDAQ, right? As long as you're over that previous all-time high, I think it was 503, give or take. It's very difficult to build a compelling short argument. If this is going to turn into a double top, of course, your neckline is the previous all-time high. So don't get me wrong. This idea can unfold. This can be in play this upcoming week, but I just would not be premature on that move. I do think that Friday's session is starting to suggest that maybe buyers are running out of bullets, so to speak. The momentum is slowing down. We had this retest of 444, and it just did not find any sense of buyers. Actually, we got consolidation, a lower high underneath, back in the midpoint of this junky range down here. So I'd be sort of patient out of Tesla. If it's going to be a long, show me this, and then we'll get back on the horse. If it's going to be a short, show me this, in which case we have that stronger opportunity we just described on the daily for that larger breakdown into the previous breakout level down here at 358.50. I'm not calling for this in the blink of an eye, but over time, in theory, that's the structural target. Let's move along to JP Morgan. We're in the midpoint of the range, don't enter in the center. This is the same idea, same concept as the XLF, but generally the look below and fail should do what? It should target the top end of the range. That would be bullish for the S&P 500. We'll keep tabs on JP Morgan for that exact reason, but not really look to trade it. Here's Netflix, starting to be a little ugly in this range, not cleanly resolving this or this. If we take it down to the hourly, you can see that. So I'd be a little reserved here on Netflix. I think my first thought would be if this is overhead supply, this needs to instantly hold a lower high on Monday morning, then an equal low flush is probably where the trade unfolds. Under 894 trades to 868. That would be the trade setup there. If it's accepting in here, maybe a Stevie Wonder for the thin structure retracement if you want to take that idea. Maybe something along those lines, but it's a lower priority. I would really say that NVIDIA looks better. I would say that Apple looks great. I would say that even Amazon looks okay there. Tesla looks interesting. If we need shorts for the market, right, I would prefer to look at Tesla, not necessarily Netflix for this, right? So anyways, that's the take there. Now look at this little guy. AMD is making a guest appearance on the core list of companies. It's not included in the 3 additional trade ideas I have for you in just a moment, but everybody and their sister's brother's mother, just like they could see the NVIDIA head and shoulders on the daily chart, everybody can see this AMD inverted head and shoulders on the hourly. So consolidation over 124.35 that breaks over the neckline here, really think is a compelling argument, even if it's just a counter trend move, right? Let's take a look at the daily time frame chart. It's been beat up big time. Even if this is just a small counter trend move to get to here, set a daily lower high, have the 50 SMA come down on it, that's fine, but there's a tradable opportunity here for sure around this 127.15 neckline. So have that on your radar. It's a good segue into our first additional trade idea. If you think that semiconductors are going to catch a bid this week, take a look at MU Micron, right? Coming into previous historical support down here. This historical support, this was a large gap down on earnings, of course. Look at this little consolidation. If we take a look at the hourly time frame chart, it's not quite a clean cup and handle. The handle's one heck of a handle here. But this consolidation range, if it can persist, probably allows for some move over 91 into 96, 5 points worth of range, probably worth trading for into a gap structure overhead, right? You're not looking to be a hero here. You're not looking to close the gap all the way, but just retesting the bottom end of this range from back here would result in a pretty nice trade. So that's MU. If we need longs, if semiconductors are on the move over 91, we have a trade into about 96 based on holding key support from the daily perspective here. Let's start talking a little bit less about semiconductors, but still technology. We've got SQ Square, which is basically a sleeper of a Bitcoin proxy, right? What is this? This looks scary, right? Look at this thing. There's your head and shoulders. Any weakness out of Bitcoin, and I think you start to see SQ fall down a bit here underneath 87.75. Yes, mind the daily 50 SMA, but generally speaking, this rally was the result of earnings and also the understanding that Bitcoin was going to influence the move. If we take a look at the hourly chart structure, it's straight up, right? Straight up through here as well. So even if it's just a thin structure retracement to the first stop at 82.15, setting up some sort of risk reward along these lines here is probably worth paying attention to on the unfolding of your good old head and shoulders pattern on SQ. So that is that block. Thanks, Jack Dorsey, for the idea. And then finally, getting even further away from the technology theme, we have OXY, Occidental Petroleum, right? And this falls into the XLE theme. And remember, when I was talking about the energy sector, I was saying, hey, we have a short idea in the XLE as a sector, and the individual component is Oxy. Look at this beautiful inverted hammer on the Friday session, confluence with the 50 SMA, the previous flush point here at 49.60. If you see rejections of that level, I would start retargeting the equal low at 46.15. It's not the best mover. Obviously, this is a very compressed y-axis relative to our tech counterparts, which have a much higher beta, of course. However, it's just a decent structural trade to be watching out for. It's a slower mover if you're looking for something to ease into to start the new year, perhaps with it's not you're not gonna wake up one day and have Oxy trading 60 unless earnings, of course, come out, or Oxy trading at like 35, right? It's just not gonna happen. So an easier mover here out of OXY to end today's weekend update as we head into, yet again, another holiday week's worth of trade. So hopefully you all had a Merry Christmas and a Happy Hanukkah if you celebrate that. I know it kicked off on the day of Christmas this year. And hopefully you all have a fantastic and happy new year as well. Remember, markets will be closed on Wednesday, no half day on Tuesday. It's a full trading session. We will be live every day of the week up in the penthouse doing the pre-market prep, which kicks off at the 8 o'clock Eastern time frame. Hope to see each and every one of you there. If I don't, that's A-okay. It's a shortened holiday week. Enjoy time spent with friends, family, and whoever else you deem appropriate. We'll see you back in the next one. As always, stay green.